A very good afternoon, everyone. My name is Vikram Advani. I head sales for Aditya Birla Alternate Assets. Welcome to today's webinar under our weekly Market Navigator Expert Series. The topic for today's discussion is trend spotting, 5 big trends for the future and the launch of our alternate assets annual market outlook. It's a pleasure to have Pranav Uniyal as our host today for our webinar. Pranav is the head of products and PPG investments for HDFC Securities and is a veteran in the industry with a work ex of over 16 years in wealth management. He's also an MBA graduate from IIM Calcutta. Our expert today is Vishal Gajwani, head of equity investments with Aditya Birla Alternate Assets. Vishal has a work experience of over 14 years in equity research and portfolio management. He's also a gold medalist, chartered accounting. I'm sure today's session is going to be extremely enriching. As a participant, you can type in your questions in the Q&A section that you see on your particular screen and post the webinar, which will be for about 45 minutes. We'll be more than happy to take your questions as well. So without any further ado, Pranav, over to you.
Thanks, Vikram. Delighted to be a part of this conversation and thanks for inviting me. So, Birla and Vishal have come out with very interesting studies in the past. So I'm very much looking forward to listening on this one. Vishal, congratulations on a new study, which is trend spotting. Would love to hear from you on what made you launch this as an annual feature. It's considered that bottom-up investing is the most effective, isn't it? Wherein you focus on managements, companies, and their growth opportunities. So why do you believe that identifying trends is important for alpha creation?
Hi, Pranav. Thanks for the question, Pranav. Good evening, ladies and gentlemen. So as the name suggests, trend spotting, the idea of this research work was to look at and identify the trends which have actually played out in the Indian equity markets over the last 2 decades, and to see what are the learnings from those trends and try to apply those learnings to identify future trends. So that was the thought process behind this study.
Right. So could you just walk us through some of the findings? Could you just spin a story around it? Could you let all participants know?
Yeah, absolutely. So let me start by sharing my screen. So Pranav, to your question on why trend spotting, because one can actually identify bottom-up stocks and invest and also make money. So why spend the entire effort to do trend spotting? So what we did is that while we were working on the subject of trend spotting, we tried to look at different market cycles over the last 2 decades in terms of how the returns have been made by different sectors in these market cycles. Here you can see that the top sectors in each market cycle have actually generated returns which are much higher than the bottom performing sectors. Now, for example, in October 2002 to January 2008, the industrial sector generated 79% annualized returns during that period, while the media sector generated just about 16% CAGR returns during that long period of 5.5 years. The difference between the two being almost 50%. Similarly, if you look at the last if you look at the average returns of the best performing sectors in each cycle, the CAGR return is 30% for the best performing sector, while for the worst performing sector, it is minus 18%. So again, a gap of almost 50% annualized gap between the top as well as bottom performing sectors. Now, how did we identify the market phases? So you can see here is that the market phases are actually divided based on market movement. A bull market is considered to be one phase. A bear market is another phase. Long sideways market is being identified as another phase. So as you can see here, for the last 2 decades, we have divided the economic phases through these red dotted lines, and you will see that the GDP growth, INR depreciation, interest rate movements are mentioned here for each of the market cycles, which is where you will see that the GDP growth, etc., was much different in these cycles. So that's how we have identified these phases of the economic cycle. This is a pretty interesting chart, and to a great extent, this actually also summarizes why trend spotting is so important in equity markets. Here, what you can see is that the top performing sectors in each phase are being marked in green, and the sectors which are being marked in yellow are actually the top performing sectors of the previous cycle. So let me take an example again of January 2008 to October 2008. During this period, which is Jan 8 to October 8, the top performing sectors were consumer staples, healthcare, pharma, automobile, and communications, which are marked in green and coming at the top. In the same column, you would find the yellow highlighted sectors, which are utilities, metals, industrials, financials, and consumer durables. These are marked in yellow because these were the top performing sectors of the previous cycle, which is 2002 to 2008. As you can see that in each phase of the market, there are a lot of yellow sectors coming in, which means that these were actually the best performing sectors of the previous cycle. So clearly, if one is identifying the right trend, then one can capitalize on returns. But if one ends up owning the same sector across cycles, then one would go through these corrections where the sector leaders of one cycle becomes laggards of the next cycle. Moving on, let us just quickly look at the past trends over the last 2 decades and see what are the learnings from those. The first trend is the infrastructure theme, which played out from 2003 till 2008. We all know that during this period, the infrastructure sector did quite well, supported by the government reforms, and also private sector participation was allowed during this period. Apart from that, there was support to the sector in the form of very high inflow of capital, both domestic as well as foreign capital, chasing investments in the infra sector at lower cost of capital. What this led to was massive outperformance of infra-related sectors like industrials, metals, utilities, cement versus the benchmark, which is Nifty. Versus broad market, these infra-related sectors actually outperformed by a big margin. Not only that, the rally was actually supported by very strong sales growth of the infrastructure sectors companies versus the broader markets. Sales as well as profit growth was much higher during this period. The second theme which played out was the exports theme from 2011 till 2015. This was again mainly led by INR depreciation. INR depreciated during this period from 2011 to 15 by a big margin, from 44 rupees per dollar to going to as high as 64 rupees per dollar, a 50% depreciation in a short span of 3.5 years. So in this case, sectors like textiles, auto, pharma, IT did much higher, much better than the broader market, including Nifty, which delivered just about 10%, while the other sectors delivered much higher returns. Again, the same phenomena played out where the sales growth and profit growth for these sectors, export-oriented sectors, was much, much higher than broader markets. The third theme that I'm going to talk about is the great Indian consumption story, which has been playing out for the last 4 or 5 years, and seems to be the case that it has multiple legs and may continue to play out even going forward. We all know that in the urban context, we have seen rising incomes and preference for premiumization, which is what is driving consumer choices, and which is what helping discretionary consumer discretionary product sales. But apart from that, over the last 4 or 5 years, we have seen vibrancy in the rural economy and also increased availability of retail financing, which is driving this growth of Indians' consumption. When consumers preferred better quality products and premium products, the organized sector also ends up benefiting, which is where the entire shift from unorganized to organized, from non-branded to branded, is what is playing out in the Indian context, again helping the listed companies. As we can see here, consumer durable companies reported CAGR returns of 32% during this period, followed by retail, consumer discretionary, and staples, while Nifty delivered just about 15% CAGR during this period. As one can see on the right-hand side, the return on capital of these companies was much higher than broader benchmark, and so was the sales growth during this period. The fourth theme is the supply chain diversification in chemicals. In this chart, you can see that from 2007 till 2017, how has been the market share movement in the chemical sector in terms of exports. As one can see, China's market share has actually moved up in the chemical industry from 15% in 2007 all the way to 37% in 2017. However, all other, the developed markets in particular have lost market share. India on low base has actually gained market share, but incrementally is expected to gain higher market share because of the benefit of lower labor cost and also because of the PLI scheme. The chemical sector again from 2016 to 19 has delivered a 24% CAGR returns versus 15% for the benchmark, along with very high sales growth and profit growth versus the broader markets. The fifth theme is the NBFC saga. 2014 to 19 was a period when NBFCs have actually done much better than broader markets as well as their counterparts, which are banks. There have been a confluence of factors which have helped NBFCs to do well. Apart from identifying the right gap where banks were not willing to lend to the unorganized sector, the sector where which was unbanked because of lack of income proof. So, for example, be it microfinance, gold loans, consumer durable financing, commercial vehicle financing, or financing to the self-employed people in the middle income category. Because of lack of income proof, banks were not comfortable lending, and the NPAs in certain cases are also on a higher side. NBFCs actually identified this gap and started lending to this space by charging higher interest rates to keep a buffer for higher NPAs, and this became a very viable business model. So during this period, the financials, which is basically NBFCs, delivered returns, equity market returns of 21% CAGR versus 12% for Nifty and just about 6% for the banking index. So clearly, NBFCs have actually done quite well during this period. And we all know last couple of years have been challenging, but within that also the largest NBFCs are actually doing quite well. And an NBFC like Bajaj Finance has come back very strongly post-COVID impact. So having seen the last 5 trends over the last 2 decades, we thought to study what are the big learnings from this, what drives these big trends, and can we apply these learnings to identify future trends. So on that front, we actually, after researching a lot and brainstorming with various economists, we have basically come out with 4 big drivers of trends. And the first one is pretty obvious, which is phase of economic cycle, where what is the GDP growth, how is the interest rate cycle behaving, INR depreciation, which will drive trend for a particular sector. As a case in point, if the GDP growth is very high and interest rates are low, in that scenario, discretionary consumption does quite well, be it real estate, automobiles, consumer durables. In high GDP growth and low rate environment, discretionary sectors do well. While if the interest rates and inflation is very high, then you have pharmaceuticals and FMCG which end up doing well. So that's one determinant of which trend will play out, which is phase of economic cycle. The second one is government policy focus. So we have seen infrastructure space doing well from 2003 to 8 because of very favorable government policy setup. Similarly, right now we are seeing manufacturing, focus on manufacturing in terms of a PLI scheme of the government, which again is favoring the manufacturing sector at the moment. And the third driver of big trends is industry disruption, and which companies are doing this disruption. So a case in point is digitalization as a theme is actually disrupting multiple industries, and companies who are at the forefront of digitization are able to benefit from this trend. The fourth one is emerging sectors. Companies belonging to emerging sectors, which basically have long runway of growth, end up doing very well from a trend perspective. So again, these sectors may be loss-making today, but will have very strong potential of growth by making the right investments. So these are the four drivers of big trends. And if you look at how these and there are multiple sub factors into each of these drivers. And if you look at the enablers of past trends, if we plot it on a 4x4 matrix, this is how it will look like. So infra-led GDP growth is being driven by economic indicators and government policy. Exports is being driven more by industry disruption. Consumption is driven more by economic indicators as well as emerging sectors, and so on and so forth. These are some of the key success stories for Birla Sun Life alternate assets into these few themes that we talked about within chemicals, consumption, exports, and NBFCs, where BSL AMC alternate assets has owned stocks into these themes. So back to you, Pranav.
Thanks, Vishal. That's a very fascinating summary of and an interesting study of what's really happened and panned out over the decades. So, I would love to understand, where do these learnings take you in terms of spotting future trends? We would love to hear you there. And B, just wanted to also understand what is, are these statistical or probabilistic outcomes that look, these are sectors, some sectors obviously will be thrown up for each, let's say, bull run or long runs in the stock market, or is there a more structural story to the sectors that have come up for each of the cycles?
Right. So so thanks for the question, Pranav. We believe that these are more structural themes because the drivers of these themes themselves are playing out over 3 to 5 years. For example, if I take government reforms, so when those are the drivers for the theme, so the reforms actually take their own course, and it takes around 3 to 5 years for those reforms to come into practice, be implemented, and that's where the themes run their due course from 3 to 5 years period.
Sure. So the $1 million question, what do you have for us in terms of the future trends that you're looking at?
Yeah, sure. So let me start sharing my screen and also take you through that in terms of the future trends. So we have identified 5 trends, 5 themes which we believe can play out over the next 3 to 5 years. And the first one being the rise of domestic manufacturing. We talked about the government policy support, which is basically instrumental in and a very strong driver for a trend to play out. And so far as domestic manufacturing is concerned, there are pull factors, which basically include government policy support in the form of PLI scheme, in the form of import duties, higher import duties for products which can be indigenously manufactured. For example, we saw increase in import duties for mobile phones, and mobile phones are now being manufactured in India. Same is the case with consumer durable items like washing machines, refrigerators, ACs, which are now being manufactured in India because of higher import duty, and also PLI scheme, which is actually providing the right infrastructure support, tax benefits for companies who are willing to invest for manufacturing of these products. Apart from that, we believe that there are a lot of pull factors which also help giving multiple legs to this theme. The push factors are basically the US-China trade relations, which have gone sour, which is where developed nations are actually looking at multiple alternative sources of supply, and their dependence on China they feel is very high, and they would want to uh, uh, reduce that dependence. And which is where we have seen industries like chemicals and many other industries. Uh, the US and European buyers want to actually buy from India. And by the way, labor cost in China is also going up, while India's labor cost continues to be really competitive in the global context. So this is one theme that we believe can play out very nicely over the next 3 to 5 years. And the sectors to benefit from this theme include chemicals, pharmaceuticals, industrials, electronics, and automobiles, including ancillaries. The next theme is digitalization. So here, again, there are three drivers to this theme of digitalization. The first one is the low cost of data. As one can see here in the left-hand side chart, the data cost in India is one of the lowest versus developed as well as developing countries. Versus US, where the data cost is $12 per GB, our data cost is $0.3 per GB, which has led to very high increase in internet usage in the country. From almost 30 crore subscribers to internet, mobile internet, that number has gone to as high as 65 crores today, and is expected to reach 100 CR consumers in FY25. Also, if you look at the data cost, the per capita data consumption in the country has actually gone up from 1 GB per month to as high as 10 GBs per month. And this for the country like US would be around 8 GBs per month. The second is government initiatives on digitalization, which basically talk about setting up the right infrastructure, which includes digital payments infrastructure, including UPI transactions, and also digital identification program, which is Aadhaar card enrollment. Both these things have actually led to people being able to actually go for a new SIM card sitting in their offices or homes without having to visit any shop. And we all know digital banking, etc., which has become so convenient for each one of us. The third one is digital adaptation by the private sector. So apart from the Indian IT services companies, all other businesses like financial services, logistics, education, retail have been forced to digitalize in the wake of the pandemic. And also without that, companies which are digitally ahead were actually growing at a much faster pace than the traditional companies. So all this is leading to companies which are digitally ahead benefiting, and the sectors which we believe can do well because of this trend include fintech, online retail, IT services, automation in manufacturing, and online platform businesses. The third theme is cyclical revival in real estate. So here again, we all know for the last 8-9 years, the real estate market in terms of property prices has remained largely flat for the last 8 years. And on an inflation adjusted basis, one can say that the prices have actually corrected. Also, in today's scenario of low interest rates, the housing affordability index has actually improved dramatically. As an example, for a suburban house purchase in Mumbai, the property price to income ratio was in the range of 6 times to 7 times in 2003 to 2007. But today, the property price to income ratio has fallen to as low as 4.5 times, which again shows that affordability quotient has improved. So here one can see that 2008 was a good period for real estate cycle. 2009 got impacted by the global financial crisis, but post which till 2013 the property prices were going up, post which they have flattened out. We believe from the next 3 to 5 years perspective, the organized property companies can actually do much better, uh, because there is a natural shift of consumer choice where people are preferring more branded, more quality construction. And of course, because of things like Real Estate Regulation Act, the branded players are benefiting at the cost of unorganized. But apart from the residential developers, we believe the ancillary service companies will also benefit from this trend. When the real estate ownership picks up, even if the prices don't go up, but the transactions go up, secondary or primary transactions go up, then the ancillary companies like electrical consumer companies, electrical products, consumer durables, building materials companies will all benefit because of the real estate cycle doing well. So that's something that we believe the entire gamut of companies which directly or indirectly benefit from real estate will actually tend to benefit from this trend. The fourth theme is sustainability. Now, there is one a pretty interesting survey that is being done by the World Economic Forum each year, where it lists down the top 5 global risks in terms of likelihood. And as you can see in this table, we have plotted the top 5 global risks in terms of likelihood from 2010 till 2020. The risks which are highlighted in green color are the ones which are related to environment. And as we speak today, almost all 5 risks which are being surveyed to be the most likely global risks are all falling into the category of environment risks, right from extreme weather, climate action failure, natural disasters, biodiversity, and environment disasters. We believe sustainability as a theme, therefore, will be really important focus area not only for the governments but also for the corporates as well as consumers. And who can benefit from these themes? We believe it could be green fuel companies, companies which are focused on green fuel, green mobility, companies creating sustainable businesses uh, from the chemical space, clean technology, green energy, and healthcare. So these are some of the industries which can benefit through this sustainability theme. The last one is a revival in mid-cap as a theme, which has to some extent played out. As we know, the last 1 year has been really good for small and mid-cap companies, which have done exceedingly well over the last 1 year. But we believe that going forward, also the small and mid-cap companies can actually continue to do well, because if one looks at the earnings CAGR for Nifty mid-cap companies, it is expected to be around 40% CAGR versus 27% CAGR for Nifty 50 companies. Also, a lot of companies in the emerging sectors come from the mid-cap space. For example, companies in the diagnostic space, which is an emerging sector, or consumer discretionary, or chemicals for that matter, are all coming from the mid-cap, small and mid-cap space. And when these sectors do well, small and mid-caps also end up doing well. So this is the summary of the trends for the future, starting with manufacturing, digitalization, sustainability, cyclical revival in real estate, and lastly, revival in mid and small caps. These are just to tie in the enablers of future trends. So here one can see that rise of domestic manufacturing benefits from economic indicators and government policy. Digitization benefits from industry disruption as an enabler. Cyclical revival in real estate benefits from government policy, economic indicators, as well as it being an emerging sector. Sustainability again benefits from government policy, and it's an industry disruptor. And lastly comes revival in mid caps. These are some of the portfolio stocks which we have across our equity portfolios, and we have just identified which theme these portfolios are playing. So we have got companies which are basically invested, that we have invested, and which are participating in all these 5 themes that we just mentioned. So that's all from my side on the future themes, and back to you, Pranav.
Thanks, Vishal. So, again, very informative, and I'm sure there would be a lot of questions around these five themes that you talked about. So, investors, ladies and gentlemen, please feel free to leave your questions. I will actually pick them up and ask those questions to Vishal. Some of the questions from my side, Vishal, you talked about domestic manufacturing as one of the big themes, but it's been spoken about in the past too when Make in India campaign was launched. So what gives you the conviction that this time will be different? Have you started seeing any green shoots with respect to the private capex, and which sectors could drive capex, private capex in the near future?
Right. Yeah. So I think apart from the government policy support, I think we have a big domestic consumer base, which can actually, which is a driver of demand for this sector. And also, as I mentioned earlier, there's a lot of pull factor where global corporates actually also want to diversify their supply chain away from China, and which is what is also driving domestic manufacturing, where companies in the chemicals, auto, electronic space are benefiting from exports opportunities in US and Europe, where people want to have a China plus one strategy. So clearly, I think this space, we believe it's a structural story and should play out for the next 3 to 5 years.
Sure. And on digitalization, again, as a theme, would you want to play this trend through ITS services company, which are really the direct technology companies, or you want to focus more on spaces like fintech, online retail, etc.?
Right. So that's an interesting debate, Pranav. The Indian IT services companies clearly benefit from this trend. But the only thing is that uh, these are mature, large companies, and they benefit as service providers into this trend. But if you have a fintech platform, which is actually 100% digital and which is a part of emerging sector, we saw one listing, big listing, just a few days back of Zomato, where on listing itself, the company reached a market cap of 1 lakh crores, while in terms of profits, it is still loss making and the revenues are also less. But clearly, the market understands the long term potential of such businesses, which are quasi monopoly and also um, have the ability to disrupt the existing businesses and create a profit pool for them as they mature. So I believe that from an investor standpoint, the safer way to play is through IT services, which will have lower volatility. But there are other options as well, including the platform players, where the risk reward is high, but at the same time, the volatility and risk will also be high. But I think it should be a balanced approach between these options.
Sure. And on real estate, we have seen the long super cycles, cycles where, investors made 2x, 4x, 8x returns. That was followed by cycles where neither the underlying asset class, which is property, or for that matter, the stocks that the investors were owning did anything, right? So, given all of that, and investors have in fact, have probably also tried to dabble with this, thinking that there's a recovery around the corner, only to be disappointed again and again. So, given that backdrop, how strong is your conviction on the slides that you presented on real estate as a strong thing to look forward to?
Yeah, I think one thing that we all agree is that property ownership is something that and affordability. The affordability has clearly improved across the board, across the country. And ownership is something that need for ownership is also going up because in this pandemic, people have realized that home is the place where people actually conduct business, and also the kids study for school through homes. So that's where I think need for real estate has actually been felt very highly during these times. And some people have migrated back to their homes and want bigger homes at their places. So that's where we believe that demand for quality real estate will be definitely be there. But the way to play this theme could be through ancillary sectors, which can actually provide a better risk reward framework. For example, if one wants to play this theme, can one look at the cement companies for that matter, which can benefit from real estate as well as the infrastructure theme. So that is one way of looking at it. Second is, as I mentioned, the branded players, um, which is consumer durables, electrical appliances, um, etc., building materials, are also very good ways to play this theme. And even if one is wrong in assessing this theme, one will not lose too much by participating in high quality businesses that I just mentioned.
Sure, thanks. And let me remind you, ladies and gentlemen, please feel free to ask questions. While I have a set of questions that I would love to ask Vishal, but I'd also be looking at the window to see your questions and parallelly ask them as well. So please leave your questions. So Vishal, back to your themes, the sustainability theme, right? Now, what is absolutely surprising is the World Economic Forum chart that you showed, and very astounding that absolutely all the main drivers of the risks that are being shown now are sustainability or environment related, right? So the only risk that and no, everybody agrees and nobody denies it, right? I think the only risk that the investor faces is the risk of investing too early, right, in such a theme, right? Nobody denies that this theme will take center stage one day, but so what's the risk of investing too early? And when do you think it taking the center stage for all the investors?
Right, right. Again, that's a very important question from an investor standpoint, because investing too early also many a times leads to opportunity loss in some other sectors which might be doing well. But at the same time, I think from an investor standpoint, one also has to be cognizant of the risk of investing too late. We have seen companies like Amazon, for that matter, Facebook, for that matter, when they got listed, they were loss making. They continue to be loss making for the next 4 or 5 years after getting listed, uh, and post which they turn profitable. But if one would wait for companies to be profitable to prove that sustainability as a theme, for that matter, as an example, is a genuine theme, then many a times one misses out on the initial uh, return, which is many a times in the range of four times or 5 times the initial investment. So clearly, I think there is a risk of not investing enough in the emerging themes, which one also needs to be cognizant of. And again, within sustainability, one can actually pick and choose. If one wants to play mature themes, for that matter, those themes are also available in the form of green chemistry, for that matter. So a lot of companies in the Indian context are benefiting from green chemistry, be it companies like PI Industries, Naveen Fluorine, etc., where the quality of where these are mature businesses. And then you have in the whole spectrum at the bottom of the highest risk category, you have themes like electric vehicles, where it is yet not proven, where the market share is sub 1% in the Indian context, and therefore the risk, I would say, is pretty high for EV sector, which is a part of sustainability theme, but very much emerging in that context.
Sure, thanks. Sorry, I have some interesting questions lining up, really. So let me pick up some of those questions. A low interest rate appears to be a common factor across most themes. How do you foresee the interest rate shaping given current scenario, and can a rise in rates play a spoiler?
Right, right. I think that is a top of the mind question for many investors, not only Indian investors, but even global investors. And we all know that interest rate cycles are globally very highly correlated, which means that if the US Fed raises interest rates, then all the developed and emerging markets have to follow suit in terms of raising rates sooner or later. So that's where I think the debate boils down to what is the US Fed going to do over the next couple of years. So from that perspective, I believe that the first thing is how is the inflation going to behave? Because the interest rate increase is always in response to high inflation. From what we know today, the inflation expectations in the US US economy are pretty much muted for now. And as per Fed's own guidance, the first rate increase is not going to happen over the next 12 months, and it might happen beyond the 12 months period. Also, the US bond yields, if you look at the 10 years and 30 years bond yields, have not gone up and actually are going down, which is also an indication that the bond investors are actually worried about low inflation continuing for long, which actually is not a bad scenario for equity investors in US and worldwide, where the expectations of inflation are pretty much benign for now. But one has to be watchful on this space and take a call as a new data comes through.
Sure. Thanks, Vishal. Pharma and IT majors are highly priced now with last year's bull run. Do you think there's more steam left there? If yes, how long that may continue?
Right, right. So IT services clearly has been one of the best performing sectors over the last 1 year, and which also ties into the digitalization theme. While uh, one may argue that IT services is expensive and a lot of the euphoria is already in the price, but if you look at the growth expectations have been reset for the entire industry by a big margin, and apart from that, there are also levers to on the margins front, where margins can actually be sustainably at these levels. So that's where I believe that there are multiple legs to this theme, and it will be too early to call it expensive, and we would be constructive on the IT services theme going forward. Coming to the pharmaceuticals sector, pharmaceuticals had done well initially as the pandemic started, but off late for the last 6-8 months have been languishing. A couple of quarterly results which have come out for the last 1 week have been subdued for companies like Dr. Reddy's, etc. But pharmaceuticals as a space, I think I would say looks interesting, and one will get if one is patient enough uh, and diligent enough to look at opportunities within this space. I'm sure there are a lot of multi-baggers in these sectors.
Sure, thanks. On the mid and small cap, I remember Birla did pick up these capitalized stocks post March, April 2020, and it's done fairly well. And of course, it's one of those themes in your top five emerging themes. But how do you see that space now, given the run-up in valuations? Given that it's a foremost question in every investor's mind and portfolio managers alike.
Right, right. Yeah, sure. So, yeah, you're absolutely right, Pranab. In our portfolios, all our portfolios, we actually were able to participate in the small and mid cap rally by buying companies in this space in 2020 when the stocks had corrected, when the sectors had corrected. So, the mid and small cap weight in the portfolios had actually gone up quite a bit during that time. And that's where the portfolios benefited because of that. Uh, Incrementally, I think a lot of it has played out in terms of individual stocks. So some of our stocks have actually gone up 4 times, 5 times in the last 1 year, and where we are actually very trying to judiciously book profit from some of these themes which have played out. But I think the small and mid cap space is very, very wide and very diversified. Companies from multiple sectors are there. So some sectors clearly the theme has played out, but there are many other sectors where we believe the earnings growth will be very strong, and that's where we remain constructive on the space, small and mid cap space, where we believe we may want to book profits in companies where they have done really well, but at the same time there are equal opportunities emerging in other spaces, other sectors within the space.
So, quick extension of that, the most popular questions, right? What's the view on the overall market valuations? Markets to go up, remain range bound, or do you expect them to correct?
That's a tough one, I would say, Pranav. So, if I just look at market valuations in terms of price to earning multiples, so we are in the expensive zone. There is no denying the fact. But if you look at indicators like earnings yield, then we may not be so expensive. The gap between earnings yields and bond yields, then we are not so expensive because the bond yields are actually at much lower levels than what they have been in the past. That is the same issue even in the US markets, where the price to earning multiple is looking very expensive. But since the bond yields are sub 2%, investors are happy and willing to invest in equities because of that phenomena. But apart from that, apart from the debate of valuations, I think for an equity investor, what is more important is what is the earnings growth trajectory. So if you just look at the share price movement and plot it against P multiple and earnings growth and all other fundamental parameters, you will see there is highest correlation of equity returns to earnings growth and very low correlation to PE multiples, which means that even at high PE multiples, equity investors have made money, and even at low PE multiples, equity investors have actually lost money if the earnings have declined. And we believe that from these levels, earnings growth momentum looks really strong, and which is what makes us positive, even from these levels.
Sure, Vishal. So let me again remind the investors, please feel free to leave your questions. I have a few questions lined up and I'm picking them up as and when I see them. Vishal, I know for a fact that your ISOP and your innovation portfolios have done fairly well and consistently well. So what's going on there? What's working well for you in those portfolios?
Right. So yeah, so India Special Opportunities portfolio, innovation portfolio, both these portfolios have actually been in a top quartile in terms of performance and have delivered very strong outperformance versus the benchmark over the last 3 years. I think one reason why these portfolios have done well because they have unique style of investing. For example, in case of India Special Opportunities portfolio, idea is to invest in companies where there is a catalyst and where the companies can do well based on a catalyst like management change or micro or macro changes in the business. So this is something that basically helps us to identify companies which have gone through time correction over the last 3 to 5 years, but incrementally are going to benefit because of some such catalyst playing out. Similarly, innovation portfolio looks at companies which are more innovative within the space, within the sector, and that's where I think these are the companies which are very high quality with superlative managements, very strong capability from a research and development perspective, and these are the companies which end up gaining market share because of the ability to launch new products ahead of competition. So this is the reason why possibly we believe that both the portfolios have done well because of the unique positioning of these portfolios and the unique style of investing.
Sure, thanks. Another question that's being asked is, apart from these five themes, any notable theme that you would want to talk about?
Yeah, I think there could be a lot of themes that could emerge as we move along. But right now, all our energies are going to go into these five themes in terms of identifying companies within each of these themes where the risk reward is favorable. So that's the focus for the next 1 year. And of course, as you know, the trend spotting report is an annual feature. So I think we'll keep some of the themes for the next session that we'll have after 1 year.
Sure. You did not mention about renewable space. Any specific companies in renewable space you think would be good to watch out for?
Right. That's a very important question. And renewables actually get covered in the sustainability theme. So I mentioned about green energy as one of the sub themes within the broader sustainability theme. I think that's where renewable energy companies will get captured. So in green energy, you have companies which are basically into solar power, wind power, But apart from that, even companies which are basically into EPC, etc. Of these sectors will actually also benefit from this thing. Companies like ABB, Siemens, who are actually into the back end of enabling solar power grid, for that matter, will also end up benefiting from this theme.
Uh, uh, so there are a few questions, but Vikram, how are we doing on time? I don't know.
Pranav, maybe you can take one more question.
Sure. Okay, then I been wanting to ask you, from the alternates table, there've been quite a few winning themes, winning strategies, portfolios. Two of them you recently talked about, which is innovation as well as India special opportunities. What next? Do you have any plans on AIF or any new strategies that you're looking to launch on the AI platform?
Right. So on an immediate basis, we have filed for a new product on the AIF side, which is pending approval with SEBI, and that's something that is expected to be launched over the next 1 month. So that will be a multi-cap AIF strategy, which basically would end up investing in companies across market caps, and will also have a flavor of sectors and themes that we just mentioned in our transporting.
Sure, that'll be very interesting because I would personally love to track these sectors in the near future, and I will hold you accountable, Vishal. So it'd be lovely to see how these sectors pan out, and would also love to see the contours of the AI that you plan to launch. Right? It's like I said, over the past few years, I've really loved the kind of work and the studies that have come out of Birla, in particular, some of the interesting studies that you've come out with. So it's always a great learning to actually go through those studies and analytics. So it's been a pleasure to actually be involved with this one. So thanks for that. On that note, Vikram, let me hand it over back to you.
Thanks, Pranav, for doing a fabulous job of being our host today. Thanks, Vishal, for an extremely enriching session. And dear participants, thank you very much for logging in. If you have any further queries on PMS or AIF, please do get in touch with your local Birla representative. All the best and be safe. Thank you.